Why trading never feels like it works for you. Maybe you've been doing this for a long time. Maybe you've tried multiple technical strategies, fundamental strategies even. And no matter what happens, you always seem to get to a point where you're like, nothing's working. Does this work? Is this industry just one giant scam that is designed to take money out of my trading account and put it into the market? This is something that everybody goes through. And what I'm about to share in this video is the missing links of what everybody tends to miss in trading. And it's largely because this information is not really discussed all that much. It took me about 6 years of trading to figure this stuff out for myself. And so I hope you enjoy. So the first thing that we need to think about is, what is the purpose of the markets? The purpose of the markets is to price in value. Next logical question, what is value? Well, because there's new information coming out the entire time, there is no such thing as a perfect price. We have the agreed upon price right now, but because there's so much information coming out at all times and things are moving and people are getting in and there's positions and all this sort of stuff, things are always moving. So this idea of true value technically can't exist. So why is this important? Well, because we need to understand the market as a whole before zooming in and trying to fix any of the problems. Warren Buffett talks about a concept called Mr. Market a whole lot. So let me just unpack this. So Warren Buffett is a long-term investor. I am not. With long-term investing in equities, otherwise known as stocks, right? We have the idea that over the long run, fundamentals are going to basically be the main driver of price. In other words, if we are here and we are going up here, then we know that even if the market does this the whole way there, on average, it should assign over time to what its true value is. Because all we're really trying to do is figure out what is the future value going to be now, and in comparison from now until the future, is this going to be something that can make money? That's the idea. Now, Mr. Market is essentially what Warren Buffett would describe as this bit in between, right? Now, why is that important? Well, because when most people are trading on a shorter time horizon, like me, probably you if you're watching this, the big issue is that this bit in between is the bit where we're trying to make all the money. And so when people are going from a pure technical standpoint, they're just trading this without any idea of what's going on. So of course, when regimes change, if they don't understand how to spot the differences, and we'll go over this in a minute, that's going to be the basis for making any strategy work for a bit and then lose. But fundamentals, if you go too long, you're forgetting that a lot of these fundamental factors, obviously depending on which ones you pick, are influencing price at different time horizons. And therefore, if you're not waiting the right amount of time, then you're going to get chopped up in the middle and be like, oh, even fundamentals don't work. So it's the wrong belief because you didn't take into account time. So the next layer that we need to talk about is the idea of information saturation. Because you must understand that the more watched the market is, meaning the more participants there are and the more people talking about it on social media or on getting analyst coverage from institutions, basically the more eyeballs we have on any particular market, the more shared that data pool actually is, and therefore there's less differentiation. So what the hell does that mean in plain terms? If you have something that's watched more and more often, the data around that stock or that FX currency pair or this or that becomes more publicly available because it becomes essentially commoditized. If you think about it in terms of every day, if you have a small business versus a large business, the large business is going to have a lot more resources and a lot more people talking about that company. Therefore, information about that company is everywhere. It's popular, it's clear, it's obvious. This is the same when we deal with bigger and bigger, more and more watched markets. It's the difference between if you have a large cap stock like Apple or Microsoft or Amazon versus a micro cap stock that I'm not even going to try and pretend to know or name because I don't really use those at this point in time. And so why is it important? Well, because the bigger the company, the more information is available, which makes the information more competitive. And the markets are always trying to price in value. And so the more people are watching it, the more efficient the market is known to be. Now, what does that mean? Efficiency, market efficiency, is the idea that the market's always trying to price in value, and all of the information that's currently publicly available is priced into the stock price today. That's the idea. Now, there are lots of holes in the market efficiency hypothesis, which is where this idea first came about. However, people then take that to the extreme and go, okay, well, the markets aren't efficient and I can exploit that. That's not true. The markets are very efficient, and the bigger the market you go, the more efficient they get. For example, if I have a big stock like Amazon, everyone's watching that, right? Everyone's watching that, and so that is, like I said, all the information is going to be really available. People are going to jump on it, and things are going to get priced in real quick. If you've got a company that almost no one's watching, you can probably get an information edge there way better. But then that does come with some other risks, like it's a smaller market, it's not going to have as many people watching it. Maybe there's not enough volume for you to get in, and maybe because it's not as watched, it's going to take people, 6 to 18 months before they even figure out that you were right. Okay, so there are trade-offs at every single level, but that's not the point. So if we have a larger market, because there are less risks with, okay, I don't need to worry about liquidity. Okay, I can get in, I can get out. I don't need to worry about someone, being able to sell it to me, because, if you've got a tiny penny stock, for example, because that stock is so small, you could put your money in and might not be able to get it out because your money makes up a decent proportion of the stock, and there's no one to, buy back the shares that you're selling. And so if we look at the larger cap stocks, what does that mean in plain English? It means that you've got to understand the next factor, which is model risk. What does this mean? Model risk is, you've got to understand that most people are going through the same system of education. What does that mean? It means that everyone is trained to look at economic and fundamental data in the same way. Now, this isn't necessarily a bad thing. These methods have credit and weight, that's why they do them. However, there are weaknesses to these approaches, these models that they use. And that's important because if most people, especially the larger players in the market, are looking at the markets through this lens, if we understand the weaknesses of what they are doing and understand why they are doing that and not looking at what I'm about to share with you, that's going to be the basis to have a decent edge if you execute on it properly. There's a lot to unpack there, so let's break it down. So models, the main problem with models is they assume, I've written it down here, linear, static expectations and ignore alternative data or reflexive feedback. What does that mean in plain English, you might be asking? It's a fair question. So the easiest way to think about this is models assume that prices are going to rise steadily over time. They may account for some growth, but when it gets to growth that is exponential, when it comes to stories that are moving price, models are typically really bad at pricing that in, because models are mathematical, and the maths gets more complicated the more dynamic variables you include. That's not to say it can't be done, but it's very, very difficult. Not just that, but the people that are managing all of this money, the economists that you see on TV talking about their opinions over and over again, one of the big things that you need to understand about these people is they are not incentivized to make good predictions. They are not incentivized to trade and take big risks and go against the narrative. There are some that do that, but most don't. Why? Because they are not paid from being good traders like you and me, or the way that we might think about it. They are being paid to talk about their opinions, or they're being paid to protect their capital and just make sure they don't blow things up. If you are managing a huge fund and you're an analyst that's in the public eye, right? When you go through that process, you are going to be heavily, heavily judged if the risks that you take don't pay off. You are going to be laughed at. You are going to have a lot of public scrutiny. That is something most humans in general, but specifically in this industry, don't want to have to deal with, because they're already getting paid, they're already getting salary, they're probably already getting a bonus, and so they don't need that. Their job is to protect capital, not grow it. So when people go around these days being like, follow the smart money, why? Why? Most of the time, these guys have different goals to you. And so the whole trend of like follow the smart money doesn't really make much sense. If anything, we should be going against the smart money, obviously not for the sake of it, because we have reasons. So I'll give you an example of understanding how things change. So we could have a metric that comes out in the economy, such as CPI, which is a measure of inflation. We can have one result in, let's just say, January of a year, and then January a year later, we have the exact same result. And the market's reaction can be totally different. Let's just assume that the surprise is the same amount and all that stuff. Why is that important? Well, because if those two things can be different, it means that the actual fundamental data itself is not the whole story. It's not the whole picture, because if it was, the reaction would be pretty similar. And the answer is context. I want to shift your focus from looking at the markets through the lens that we have just described there, right? Of looking at it in the same way, basically a pattern recognition machine. We have our technical basket and our fundamental basket. And I want to shift to a third category that doesn't get enough attention or isn't as understood because it's a newer idea. And that is narratives. Narratives are essentially compression devices, right? What they are doing is they're taking complex, multifaceted things about the world and they're distilling it in our very simple minds into a nice, easy to package concept. For example, we could have multiple bits of data that are saying that inflation is going to go up. And so it's a nice and easy story for us to be like, oh, we're really scared that the inflation story is going to get worse. That's a very simplified example, but hopefully you get the point. And so we need to understand that as people, we have two layers of information. I spoke about this in one of my last videos. We have the information on layer one. On layer two, we have our interpretation of that information. Now, this is so important because if there was no layer of interpretation, the emotional aspect of the market probably wouldn't exist. Our perception is key because no one person is going to have the exact same perception as somebody else. And the whole market is never going to agree. You're always going to have people who are bullish, some people who are bearish, some people who are neutral. That's just the way that it is always going to be. So what is going to make someone change decision? Is it just data, or is it how data influences the story that they tell themselves? In other words, the layer here above the actual information itself. It's going to be here. Now, why is that important? Well, because it means that money flows according to the intensity of the belief. So the kind of follow-on point from this is that you've got to understand with the market that the market is a crowd. It is very akin to herd psychology, right? The way that we interact as people, the way we interact at scale, those things that I spoke about, economists and these kind of analysts that don't want to go against the grain. They want to fit in, they want to go with consensus because it's safer there. That's a very human thing to do. It's very normal to have those urges. Now, this is important in this context because there are clear, defined, proven weaknesses in herd psychology at that scale that again can help feed into our edge. Now we're going to get there, we are building up to it slowly, so just bear with me. So you'll find often with more watched markets that they tend to be more driven by narratives. And essentially the price that you'll see on a chart will detach from typical fundamentals because it becomes more and more based on future earnings. Now, in a sense, all, let's just say, stocks are based on future earnings. However, in this case, especially with a lot of technology companies these days, if we look at Tesla and various other companies, Nvidia, they are trading, their price to earnings ratio is way off the charts. And it's because they're more watched, people are more receptive to the narrative behind it rather than what the numbers are saying. And so what this means is that the crowd, the herd, trades expectations more and more rather than just facts. Now, this is key because if we understand the emotions behind the story, the emotions that people are susceptible to, we can intervene and build the missing piece of the trading puzzle that explains why things are shifting and moving from one season to the next, instead of going, oh, my strategy stopped working. What does that mean? Having all of the different pieces, but narrative in particular, if you're a short-term trader, and I'd count short-term as anything like under kind of 2 years would be short-term, that is going to be something that's really significant. Now, I don't trade like intraday anymore, but for me, it's going to be kind of over a few months, that sort of thing, to kind of get a clear bias. But we can go into that later on. So I want to give you just a few really kind of basic examples to understand here. So the first one is if we look at Apple, Nvidia, Tesla, sentiment and headlines move prices intraday, intra-week more than earnings revisions. Okay. Next one, Bitcoin. Bitcoin reacts violently to regulatory tweets or ETF rumors despite no change at all yet. It's purely based on rumor. This is where the old saying in investing comes from: buy the rumor, sell the news. And finally, the S&P 500 around CPI slash FOMC. Identical numbers can cause opposite reactions depending on what the prevailing narrative is. For example, if they think we're going to have a soft inflationary landing versus a sticky inflation, versus basically saying, is inflation going to go down nice and easily without the economy weakening too much, or is the inflation going to stay sticky up above? Depending on what people are scared of, that's going to influence how they interpret the data, and how they interpret the data is going to influence their decisions. This happens at scale, it's measurable, and it's predictable. So I just want to dive slightly more into the strengths and weaknesses of the crowd. So the strengths are that data becomes more readily available the more that people look at it. We've kind of already discussed that. But the weaknesses are that they are prone to herding, they are prone to fear, and often miss or dismiss contrarian narratives. So this is really key to understand because, as we've touched on before, the key word is contrarian. So people tend to stick to a story, which means that stickiness means that if that story is factually wrong and you can spot that distance between the two is part of the edge. And I'll go on to explain that in a little bit more detail in a moment. Secondly, also, larger market participants usually have a lot of bureaucracy in taking big risks, which means most public analysts, the ones with the loudest voices online that everyone's like, oh, no, this is happening, whatever, they are speaking from a perspective of being incentivized to follow the consensus narrative and to not take risk. I've said that already, but it's really important that you get that through your head because it's so key. It means that it changes the way that you interact with what these people are saying online. You can filter through it and be like, wait, why am I trying to emulate what these guys are doing? If they're saying this, probably everybody is saying this, etc., etc. So if we compare the three elements of trading that we've spoken about now: technical, fundamental, and narrative. Technicals are essentially a micro time horizon. That's where you're looking at prices. Of course, you can go a little bit wider, but for the most part, it's micro. And the essence of what technicals is showing you is it's telling you what people did. It's a past metric, historical, in a sense, metric. Fundamentals are macro, as we said, they're over a longer time period. They're telling you what the value should be. Narratives are meso, whatever. So why they believe it and what they expect next, which is arguably the biggest influence over short-term price movements. By short-term, I typically mean 1 month to kind of 24 months or 2 years. So think about it like this, right? Fundamentals are like gravity, but in between gravity, we can still jump up and down, we can run around, we can do all these other sorts of things. But narratives are like the weather. So understanding them both together is really going to be the thing that allows a full understanding of the market without just being blindsided by data or a technical pattern and being over-reliant on that stuff, because then you open yourself up to risk. This is the whole premise of what I'm trying to do with this channel. So don't believe what I say, okay? I'm just a talking head on the internet. So instead, let's go through just a couple of really basic examples of this in a future video, which I will link to later on. I'll go through in-depth examples of this happening in real time, explain how the narrative changed over time and many other things. So stay tuned for that. Depending on when you're watching this, it may even be in the description already, but it may not. Anyway, example one, Tesla 2020. So the story was the future of mobility. And the mechanism was innovation plus the cult of Elon Musk plus ESG capital. And the result was the valuation detached from earnings because the belief became stronger than the data. This is a clear example of people being like, oh my God, electronic vehicles and all this sort of stuff. This is the future. And so at a macro scale, money starts being pumped into the industry. People start getting keen. People start falling in love with Elon as a personal brand. These are all emotional things. Yes, there's some logic in there, but they're mainly emotional. Why is that important? Because as emotions ride, that is the thing that allows the belief to override the data, because people essentially have all the things that me and you have day to day: a fear of missing out, being just eager to get involved, scared to miss it. I mean, those are all basically FOMO, but I gave you three versions of the same thing, so enjoy. Anyway, the lesson here is that the narrative intensity overpowered every valuation model until it became saturated. Very key. So a more recent example, the AI mania. So the story has been for a while, AI is going to change everything on a macro perspective. The mechanism was the media began talking about it non-stop. ETF inflows, so big money being pushed into the space, and a feedback loop of these things happening over and over and over and over again. And the result is that earnings revisions, so analysts' estimations for earnings projections for companies, they lagged behind the hype by months because the story priced expectation in before the data existed. Priced in the expectation and the data followed. And if you think about this just on a simple level, if you were to just look at an individual company, you know, analysts are not often trying to really go into detail about predicting that company's earnings, right? They're doing it based off the data that's available because it's a very quantitative world now where everything is ideally being prioritized if it's mathematically provable and you can make a model out of it and all these things we've already spoken about. And these things aren't bad. They are just not efficient at the time horizons with the goals that a shorter term trader actually has, which is a key difference. So each example has basically the same ladder, and we'll go into detail more on this in a minute. We have the data, the story that forms, the belief that forms from that, the positioning, the price, the model, and the reinforcement. So this goes round in a, depending on which way this video is going to be, round and round in a circle, over and over again. So in narrative regimes, models follow price, not the other way around. This is a really important thing, but fundamentals supply the ammunition, but stories pull the trigger. So really, when you're making those missing links about, okay, why have I failed? Why has it been the case where no matter what I've tried, I just keep running into the same sort of problem? That's going to be a case where you're missing the other layers of what's going on. At the end of the day, if something's happened where you don't understand it, probably it's because you don't understand a particular element of the market and you're just too zoomed in on one specific thing. In a sense, you've experienced model risk before. If you ever used a technical only strategy or maybe even a fundamental strategy on the wrong time horizon and you've lost eventually, that's a form of model risk because you're hyper specialized in one particular view of the market without any consideration for any of the other factors that do exist and do influence prices. And you're confused when it stops working. It's like, yes, because there's other factors connecting, and understanding how they connect is really the key. So the next kind of logical question is going to be, this makes sense, but what are some real examples and proven relationships between how narratives form, how to pay attention to them, and how to really get them together and allow them to predict price movements? And that's exactly what we're going to be talking about in the next video. Hope you enjoy. Links in the description or somewhere on the end screen here. Thanks for watching. I'll see you there.